Hello everyone, welcome to EduTap, and in today's session we are continuing with the revision series for the SEBI Grade A 2022, and this is part 3 for economics. We have already done 2 parts in which we have discussed the important concepts of economics, and in today's series we are continuing with the economics series with important questions. And in today's session I have brought for you the application based questions that SEBI can give. Okay, because these will be the hardest questions that you can get in the SEBI exam for you. Okay, so good evening Neeraj, and now before starting with the session, please subscribe to our YouTube channel if you are new to the channel, and join our Telegram channel for the PDF of this session and for getting the free material from EduTap. See, in today's session we will be doing the application based questions, and more than that, that can get a little harder. But if your concepts are very clear, you will surely be able to give the right answers. And seeing the level of your preparation, I have upped the level of the questions also, seeing how well you people are preparing for the exam. Hello Nilesh, hello Tech and Game, Amit, hello. So now continuing with the session. So here is the first question, that is, what will be the income at the equilibrium level when in the economic the consumption is this and the investment is this. So you have to tell that what will be the level of income in the equilibrium level of the income. So try to give the right answer of this question. So try to give the right answer. Should it be this or this or this? So C is the consumption level, Y is the income, I is the interest rate. Here you can also understand the investment function, investment equation. Okay, so the investment equation is equal to the 190 minus 20I. That is, the investment is inversely related. That investment is inversely related with the interest rate. Okay, and this is the slope, that if the interest rate is changing, how much the investment is changing. This is shown by the slope, and this is the autonomous investment, that is the investment that does not relate to the interest rate. Okay, that you have to make the roads. The government will make the road even if the interest rate is high. So that is the autonomous investment. This is the slope, that is how much the interest rate is changing, and with interest rate how much the investment is changing. So I got 3 answers, and 2 of them is saying C, 1 is saying B. So Abhishek, you are absolutely right, and I am very happy to see the right answer here. Okay, so see, how did we get to this? How did we get to the B answer is, see, income equilibrium. At equilibrium, what will be the equation? The income is equal to aggregate demand, the aggregate supply equal to aggregate demand. And in the previous session I told you that according to Keyes, the aggregate supply is the income. So aggregate supply is equal to income, income equal to aggregate demand, and aggregate demand means consumption plus investment. Okay, so consumption is what? Consumption is 10 plus 0.5y, investment is plus 190 minus 20I. Okay, so here you can see that this is the equation, and from here we take the y to one side and we got this. Okay, so from here you get the 1/2y, and this is the real answer that you get. Okay, this is the one way to solve this. The other way is that, see, the consumption equation was 10 plus 0.5y. So similarly the saving equation will be minus 10 plus 0.5y, because 1 minus, this is MPC now. So 1 minus MPC is MPS. This is MPC, so 1 minus 0.5 is MPS. Okay, so we got the slope of the saving, and the saving will be negative 10. Why? Because this is autonomous consumption, that is this saving that you are doing. So this is how you can even derive the equation of savings through the consumption equation. Okay, this is also the application base that you need to understand, that maybe they have given the consumption and they have said that this is the autonomous consumption. What is the dis saving? Then you will say that this much we are dis saving, this much we are consuming from our past savings. Okay, and this is the MPS, 1 minus MPC's MPS, and this will be the right answer. Now see, it is saying that this is the IS curve. Why? Because what did the IS curve said? IS curve said that there is an inverse relationship between the interest rate and the income, and this equation is showing the same, that is the I is negatively related with the income. Okay, so this is how you can derive the IS equation. Okay, and this is the IS equation. From here you can derive that Y equal to AD and consumption plus investment plus GNX. The G, the government expenditure, the exports minus imports, the autonomous consumption, the autonomous investment, these all are the constants. So we are taking the constants together. This 1 upon 1 minus B and this DI will be the left out things after you solve this equation. Okay, what you have to remember is the IS equation is the application base. Okay, so this is how, this is the whole IS equation, okay, that you can read. So next is in the equation y equal to this, where a is the constant, what determines the slope of the IS curve. So you have to tell that what determines the slope of the IS curve in this question. Okay, so try to answer this one. Okay, Anshu, I hope you are able to understand. See, the IS equation I told you, the IS equation is y equal to 1 upon 1 minus b a bar minus di. Okay, so a bar is all the constants of the equation we are taking in the a bar. Okay, this di is coming from the investment. Okay, investment plus consumption plus government expenditure plus net exports. This is the equation of y, or this is the equation of aggregate demand now. So in this is constant, this is constant from here, a plus bx, so by. So this is also constant. So all the constants from investment, in the investment, the autonomous investment, that is I bar minus bi. This is also constant. So all the constants we are taking together. So what is left is this by and this bi. Through this we are coming here. Okay, if you are calculating it a little, then you will come to this equation. This is what was shown in the previous. You do not have to remember the derivation. The SEBI is not giving you 10 marks question. You just have to remember the equations and how to put the equations and where to put. So the answer of this, many of you are giving A, okay, and I am getting C also. So the right answer, only one person has given the right answer, that is Tech and Games, and well done Tech and Games. The right answer is D, because see, I have told you that the IS curve depends on the size of multiplier, okay, as well as it depends on the investment, the responsiveness of investment with the interest rate, okay, with the interest rate. And what is showing the responsiveness of interest rate, the investment with the interest rate? The DI is showing it, okay, in this equation, in the investment equation, that is here. This is the autonomous investment, and this is the interest rate with, and D is the term, that how much the investment is changing with the interest rate. Okay, so this is what is shown here, that how responsive the investment is with the interest rate. Okay, so this as well as this, both of them are the answer of this question. So the slope is shown by the di also, and 1 upon 1 minus b, that is the size of multiplier as well as the degree of responsiveness of the investment spending to the changes in the rate of interest. And this, please remember this is the investment function, which is a separate topic in your syllabus of economics. Okay, that is, this is the autonomous investment, and this is the investment that is changing with the interest rate, that if interest rate is increasing, how much the investment is changing. This is what is told by the D, which is the slope. Okay, that is showing the responsiveness, that how much responsive the investment is with the interest rate. Next question is, calculate the rate of interest when the money demand is this and the money supply is this, MD is the demand for money, Y is the level of income, I is the rate of interest, and MS is the supply of money. Here you have to tell the equilibrium level of rate of interest in the money market. Try to give the answer of this one. So what should be the answer of this one? See, the equilibrium level of rate of interest means where the money demand is equal to money supply. Okay, where the money supply is equal to the money demand. So here just you have to put the equation and the answer will be with you. And Venkat is saying C, but no, see, try to solve it. The answer will be the A. See, you have to just put that MD is 0.4 Y minus 80I and the MS is 1200. So just this is how you have to solve it, and the answer is first. Okay, that is I equal to 1 upon 200 Y minus 15. And see, this is the equation of LM curve. I have shown you the equation of IS curve. IS curve equation was 1 minus B A bar, that is the constants, minus B, that is DI. Okay, D is the slope, that how much the investment is changing with the interest rate, and I is the interest rate. So this was the equation of IS curve, and the equation of the LM curve is this. That is, see, the money demand depends on the income and the interest rate. So that is positively. This is showing that how the money demand will change with the income. Okay, that is, we want more money for transactions because we are more richer now. We want to spend now. So this is the how much you will spend more when you have more income. How much demand you will do for money more. Minus HI. This H is showing that with the interest rate increasing, your demand for money will decrease. When the interest rate is increasing, your demand for money will decrease. And from this equation, we are reaching to the LM equation that shows that I, that is the interest rate, has a positive relationship with the income. Okay, here the interest rate has the negative relationship with the income, because here the IS curve is there, that is negatively related with the income and interest rate relationship. Here the I is positively related. Here the I is positively related with the Y. There is no negative sign. Okay. So this is the equation of the LM curve, and the H is showing the interest elasticity, and the K is showing the income elasticity. So now you also know that the slope of LM curve depends upon the interest elasticity, that is how much the demand of money is changing with the interest rate, and the income elasticity. Okay, this is income elasticity, that how much the demand for money is changing with income. Okay, so this much you have to remember. Okay, this much you have to understand, then only you will be able to give the answers of the equations of the application based questions. See, I am going a little faster because I want to give you the knowledge of all of this. So now I hope you have understood. If there is any query, you can ask right now only. This is the LM curve equation that is showing the inverse relationship, showing the direct relationship between the interest rate and the income. That is, the interest rate is directly related to the, is positively, sorry, not directly, positively related, the interest and the income. They are positively related. That's why there is no negative sign in front of this equation of income. Okay, and H is the interest elasticity, Y is the K is the income elasticity. This we have discussed in the previous session also, so you can also see part 2. Okay, Tekken games. Okay, I will give you more time for the numericals. So next question is, if aggregate demand rises, what will be the effect on the real output in the short run and the long run? Easy question. If you know the long run, the short run, very easy for you to solve. So you have all the time to solve this. Try to solve this. Okay. हाँ Aditya, in the phase 1 we are expecting that such hard questions will not come, but we are continuing with the topic of ISLM, so I thought you should have the basic knowledge, and might be they will just ask the equation, that what is the IS equation, what is the LM equation, because that is the basic now. At least knowing the equation is basic. Okay, that you should have the knowledge of the curve. It is positive sloping, IS is negative sloping, and the equation you should know. Okay, so that means, that's why I'm saying just remember it. Just remember the equation if you are not trying to understand them. Okay, so I'm getting the answer B, and Nakul, Himanshu, Nisha, they are saying. So see, when the aggregate demand rises, just remember the formula, that what is the formula. So this is aggregate demand, this is aggregate supply, and this is long run aggregate supply. Okay, so now the question is saying that the aggregate demand is rising. So what will happen in the short run? In the short run, thus output will increase. So in the short run, the output will increase. Okay, so in the short run output is increasing, and in the long run, of course in the long run the output is constant. So here is the reason why. See, the aggregate demand rises, so the aggregate demand is rising, prices will rise, so output will rise. Of course output will rise because demand is more, so output will be more, but the prices will also rise. Okay, so when the prices rise, the workers will demand higher wages, because their real wages has decreased now, because prices has risen, so the real wages has decreased. So the workers will say, give us more wages, and when wages will rise, the supply will decrease, as the profitability for the firms has decreased. So supply will decrease, and we will again come back to the long run supply curve. We will again come back to the full employment level, or we will again come back to the long run curve. Okay, so in the long run always the output will be constant, but in the short run it can increase, it can decrease, anything can happen to it. If the aggregate demand is increasing, then the output will also increase. Okay, so the A option was the right answer for this one. The difference between actual real GDP and maximum potential GDP is known as what? So this, try to answer. This is also very easy, one liner. Okay, so try to answer this one. So what should be the right answer of this one? Demand gap, output gap, classical gap, Keynesian gap, or none of the above? So I'm getting the answer from Himanshu has said, Amit has said the right answer, and Suraksha was the first one that said the right answer. Ajita, Abhishek, Vivek, Nisha. So well done you guys, this is the right answer. Output gap is the difference between the actual real GDP, that is how much you are actually producing, but how much the potential you have. So this is the gap of the output. Okay, so actual real GDP and the maximum potential real GDP is the output gap. Here as you can see, this is the classical one, that if you are producing less than your potential is this one, but you are producing less, so this is negative output gap. But if you are producing more than your level, more than your potential, then this is positive output gap, which is very harmful, because in this situation the inflationary gap will be very high and it will be a trouble in the long run. Okay, so if you are producing more than your potential, it is positive output gap, and this was the Keynes one. That is negative output gap, that is you are producing at this level but your long run level is this. So when you are producing less than your potential level, then it is said to be negative output gap. Remember this also, what is positive, what is negative. Okay, so the next question is, which of the following statements are correct regarding the shutdown point for a firm? So the right answer for this one will be C. Average variable cost should be more than equal to, it should be, if it is greater than price. Okay, then it will be the shutdown will be permanent, that yes, shutdown will happen, and yes, all of the above is right. More than equal to, it is shutdown is when it is greater than usually. Okay, so all of the above is right, and the C, marginal cost will always cut the average variable cost from below. Okay, from the minimum, where the average variable cost, where the average cost is minimum, there the average the marginal curve will always, marginal cost will always cut the average cost and the average variable cost from the bottom and from the minimum point, where they both will be at minimum. Okay, so this is the diagram, that where the price is equal to average variable cost, that will be shutdown point, and below that, above that, it is the zone. Okay, and it's like when you are not even able to cover your variable cost, then though you should not be producing. Okay. Okay, so the next question is, J curve effect refers to a phenomenon wherein the trade balance of a country dash following the depreciation of its currency before it. Okay, so try to answer this one. See, even if you are guessing your questions now in economics, what happens that economics we all know, we are all suffering from it, we can say, we are all living in an economy, so we all know what inflation is. So it is very basic, so even you can guess the answers if you have the like a little bit knowledge, a little bit you want to know about the environment only, you want to know about the surrounding, that what is going on in the economy. If you know that much also, now you can answer 50% of the questions right. Okay, so this one also, what should be the answer of this one? That J curve effect refers to a phenomenon where the trade balance of country, what happens? Okay, in the case of depreciation, what is happening to our trade balance? So Tekken Games is giving the, okay, so I am getting many of the answers B, only Nilesh is the one that is saying A. So is the answer of Nilesh wrong, or are you all guessing wrong then? The answer of Nilesh is right, that is A. So see, in the starting, when you are your currency is depreciating, then what happens that directly the exports won't increase. It takes time for the exports to increase, but the import is that much only, and the import has got expensive. So for the starting period, first the trade-off balance worsens, but in the long run, after a period of time, that before it improves. Okay, before it starts to improve, first it worsens. Okay, so this refers to a phenomenon where the trade balance of a country worsens following the depreciation. Directly after depreciation, your trade balance will depreciate. That is why it has a J shape. Initial loss phase hota hai, फिर break even phase is there, dramatic gain. After that, there is a dramatic gain phase. So this is negative. Current account balance will be negative in the start. Okay, and after that, after a period of time, it will start becoming positives. Okay, so if you are doing something new now, it won't kick start in the start only. When you are growing up a startup, that also takes time. Okay, so other things remaining unchanged, market demand for a good might increase if, so you have to say, you have to try to understand this. Try to put the elimination method also if you are following trouble in the simple method. So try to answer this one. You have like 15 seconds. I think you need time for reading the options also. So try. Okay, so I'm getting the answers from Nilesh, Nisha, Vivek, Neeraj, and you people are doing really great. And the right answer for this question is A only. So this is the right answer, and I will tell you that why. Nakul also, Anshu also, you people are doing really good. Indu. So see why this is the right answer, because you should directly know, okay, that the demand is rising, so the prices must be falling. So fourth two is right from directly seeing it. Okay, so when we come to the this one, third one, inferior good. In the case of inferior good, what happens that when your income is increasing now, the demand for inferior good will decrease. So here we are talking about increasing demand. So this cannot be right, because in the case of inferior goods, when your income is increasing, your demand for inferior goods will decrease. Okay, because you will not want to go on in the auto rickshaw when you are earning so well, when you are doing so well now. So that happens in some that happens in the case of inferior goods. Complementary goods. See, complementary goods, they go in different direction. That if your petrol prices are rising, the demand for the car will decrease. So here that can also not happen. So when the market demand for a good might increase, when like the demand for Pepsi is rising, so Coke prices must have increased. Okay, in the case of substitute goods, if the Coke prices are rising, you will say that I do not want Coke, I will buy Pepsi because it is a close substitute. So you will buy Pepsi. So the demand for Pepsi will rise. So in the substitute goods, if the prices of substitute is rising, the demand for the other good will increase. In the complementary, when the price of the complement is rising, the demand for the other complement will decrease. Okay, so the right answer will be 1 and 4. Next is peak and trough of the business cycle are known collectively as what? This is very easy. I think you should not even take 10 seconds to answer this one. Yes, tech and games, very good. Due to inferior quality of the product, you will stop using it when your income increases. Okay. Okay, so I'm getting the right answer, that is turning points. It was a very easy concept. I don't think we need to put much time in it. See, this is the turning point. That is the peak and the trough in the business cycle are the turning points. It is very easy. Next is when aggregate economic activity is declining, the economy is said to be in what phase? So this you have to answer. Again, a easy question if you know that what business cycle is. This is the direct answer that you can give. So try this one. Okay, so I have got the answer from Vivek, Vinayak, Anupma, Nakul, Nilesh. So the right answer is contraction. Okay, so here you can see that here it is when it is rising, when the economic activity is rising, it is expansion. When it is at the most highest point, you have achieved full employment, it is at the peak, then the recession and the depression starts, and the recession and depression is the contraction phase. In this phase, what happens that your economic activity decreases, your investment, your employment, your demand, your supply, everything, every economic activity shows a downward trend. After that, it reaches the most down it can go. After that, the economy starts recovering. Then it again expand and reach the peak, and the cycle goes on. So the monetarist theory of the business cycle regards dash as the main source of the economic fluctuations. So according to the monetarist theory, what should be the right answer? This is an easy one. Even if you know a little about the monetarist now, you will be able to answer this question. So try to answer this one. Okay, so should it be the unanticipated fluctuations in aggregate demand, random fluctuations in productivity, fluctuations in the quantity of money, volatile expectations, or all of the above? So what should be the right answer? Okay, I am getting the answer C from Ajita has said C, Anshu has said E. So Himanshu and Ajita and Deva Data, Sahu has said the right answer. It should be C. See, why it should be C? according to Keynes, whenever Keynes come na, just say that he is talking about demand. Okay, classicals, they are talking about supply. When it comes to monetarist theory, monetarist economists na, they are always talking about the money supply. They are always talking about the money. Okay, so this is how you can differentiate between the three. That is, when the aggregate demand is coming, it must be Keynes that is saying it. Okay, productivity, fluctuations in productivity, that is the later on, the modern economist. Then volatile expectations, it is not volatile expectation, it should be money. Okay, so the monetarist theory of business cycles, like Hawthorne's theory of business cycle, considers change in the supply quantity of money as the major source of the economic fluctuation. Even if you don't know about Hawthorne, anything about them, you must know that what monetarist theory is. That is, they talk about supply, money supply. Okay, they talk about money supply. Next is, which of the following is or are incorrect regarding need and read? This you have to tell, and this is an easy question. Try to answer this one. So the first option is, need is nominal effective exchange rate, read is real effective exchange rate. Need and read are determined for each foreign currency separately. They are in a form of single number, that is the index we can say, that expresses what is happening to the value of the domestic currency against the basket of currencies. Need and read are weighted averages. So what should be the right answer? D. Incorrect. You have to tell the incorrect one. Try to answer the incorrect one. Okay. Okay, so I am getting very different answers from all of you, and these should not, see, need and read both are weighted averages. Okay, I will show you the definition given by the Reserve Bank of India of the need and read, and in both of them weighted is written. So this should not be the answer. Okay, so this is in their definition, and if you know the definition, so you must know that this is not incorrect. This is the correct statement. Okay, this is correct. This is also correct because this is of course the full forms. Now this is also correct that it is a single number, that is for the basket of currencies. What is left? Each foreign currency. When here it is written that a whole basket of currencies, then how it can be each foreign currency separately? Okay, so you see in the same option the answer is given. Either this should be right or B should be right, and this is the right one. C is the right one. Need is the weighted geometric average of the bilateral nominal exchange rates of the home currency in terms of foreign currencies. Okay, it is a basket of foreign currencies. So read is the weighted average of need adjusted by the ratio of domestic price to foreign prices. So somebody has said about inflation, and that was right. Okay, Atul, you are saying that you are a math student. Economics is very easy, especially when you are a math student, because there are equations that help you understand the basic points. And you just have to do the basic economics that will take 4 or 5 hours. Okay, just listen to the lectures and try to have the basic understanding. Okay. So which of the following is not a component of capital account of balance of payment? Again, a very easy one. Try to answer this one. Okay. And instead of banking capital, just take external commercial borrowings. Okay, so I am changing the option and try to answer the question now. So in the 12, the B is the incorrect one. Okay, we are asking the incorrect now. So B is the incorrect option, because B is saying that for each single currency. That doesn't happen. It is a basket. Need and read are the basket of currency against the foreign currencies, not currency. Okay, so B was the right answer for that one. Somebody has asked. Okay, so next is 13th question, and Anshu is saying that transfer payment are a part of current account. Well done, Anshu. That is right, that transfer payments are a part of current account, so they cannot be a part of capital account, and that's why this is the right answer. Okay, so capital account includes the investments, it includes the borrowings and external assistance. In the investment, it can be direct investment like the foreign direct investment. It can be portfolio investment, that is foreign institutional investment or foreign portfolio investment. In the external borrowings, it can be external commercial borrowings, our firms are borrowing from outside, or short-term debt, that is loan in a form. External assistance like the government is taking the aid, the government is taking the loans. Okay, aid means not free, it is for less interest rate. Okay, so aid and loans the government is taking. Next question is, under which account of BOP the profits, wages, interest earned by Indian factors abroad will be added? This is an easy question if you know the basics of the accounts. Okay, so try to answer this one. Nisha, you are clear about, I hope you are clear about the 12th one. It was the B answer. Okay. Okay, so Vivek, Vinayak, Nilesh, Adumpma, Suraksha, they all are saying C. And that is the right answer. So well done you guys, this is the right answer, that is the current account. So why this is the right answer? Because see, in the current account we are taking the trade in goods, that is the export and import of goods. We are taking the trade in services, that is the services that the our factors are providing outside or anywhere. Okay, so trade in services, it includes the net factor income from abroad, that is the factor income from abroad we are earning minus the factor income to abroad that we are giving, that is included in the current account. And you must know, you should know that factor income means the income that is earned by the factor services, that is from the labor is earning the wages. Okay, the entrepreneur is earning the profits, the capital is earning the interest, and the land is earning the rent. So all of it, all of the services, like from the services that the factor services that we are giving, whatever we are earning from the factor services come under the current account. And net non-factor income means the traveling services, the shipping services that we are providing, that doesn't come under the factor service, so it will come under the non-factor income. Then the transfer payments means the gifts, the remittances that we are getting from outside or we are giving outside, that is under the current account. Is this clear to the people that like how the profit and all is coming under the current account? Because it includes the net factor income. Next is, both foreign direct investment and foreign institutional investor are related to investment. Okay, they both are investing. Which one of the following statements best represent an important difference between the two? So you have to tell that both are investing. So how are they different? Very easy question. Yes, factors of production were the land, labor, capital and entrepreneur. Okay, factor of production is providing factor services. Okay, and factor services, for factor services we are getting the factor payments or factor income. Okay, all of that includes in the current account. Okay. Okay, so many of you are giving the answer B, and it should be right, because foreign institutional investor helps in increasing capital availability, because they are buying our portfolios, they are buying our shares and all in general. Okay, why FDI, foreign direct investment, brings in resources. Okay, it is bringing the managerial resources, it is helping us build something in our country, building factories and all. So it is bringing the technology with itself, it is bringing the managerial skills. So foreign direct investment, shortly known as FDI, refers to the investment in which foreign funds are coming into our country and based in a different country. From outside it is coming And the investor companies in general, the investment is made to gain a long lasting interest in the investing enterprises. Okay, so they are investing in our enterprises and it is for long term, because they are in like building a company, building a factory or something. They can't wrap up a factory in one day now and just leave. While in the foreign institutional investors, they can just wrap up, they can just sell the bonds or whatever they have bought in the financial market. It is very easy for them to take out their money. For foreign direct investment, it is a long-term relationship, we can say. So which transactions are made due to some reason other than to bridge the gap in the balance of payments, that is when they are independent of the state of BOP. So this, try to answer, they are independent of the state of BOP. So what should be the right answer? In the question only, in the terms only, the answer is given. Okay, so I am getting the answer A. It should be the B. Autonomous, see, independent of the BOP. So it is autonomous transactions. Accommodating is when you are taking care that deficit is happening, a surplus is happening. So we have to take care of that. So in the accommodating items, these refer to transactions that take place to cover deficit or surplus arising from autonomous transactions. Autonomous are the firms that they are transacting, they are doing. Okay, they are doing it for their own profits for motives like earning income. So autonomous items are independent of any other thing of what is happening in the BOP. It is favorable or not. So the firms are not thinking about it is favorable or not. The government has to take care of the BOP, okay, balance of payment, and they have to accommodate. So the government is accommodating. Okay, so in the autonomous, it is independent items. In the accommodating, the government is taking care of the balance of payment. It is in surplus or deficit. Okay. Next is which of the following. You can take a screenshot if you want to read it all. Okay. So next is which of the following is or are correct regarding the exchange rate. This is also an easy question. Try to answer it. So it is the rate at which one currency can be exchanged for another between nations of economic zones. This is right. It is telling the exchange rate between the currencies now. So it is how the one currency is exchanged for the another. Like 1 rupees is equal to $0.3 or something. Okay, it is not right. I am just giving you the example. So it is shown that how much the 1 rupees can take for the dollars, or how one currency can be exchanged for the other. Like $1 is equal to 71 rupees or something. So how the dollars can be exchanged for rupees? This is what is shown by the exchange rate. Exchange rate regimes can be of different kind. Peg value was there, then the fixed came, then flexible came, then managed floating is going on also. So fixed exchange rates are decided by central banks by a country. Yes, it is true that fixed exchange rates are decided by central bank, while the floating or flexible exchange rates are due to the market mechanism, due to the supply and demand of the currencies. Okay. India follows fixed exchange rate regime. This was a very easy question, I must say. Okay. So India does not follow fixed, it follows managed floating exchange rate, that the RBI is managing the exchange rate, that it does not surpass a level of appreciation, it does not surpass a level of depreciation. We have to maintain it in a range. Okay, we have to maintain the exchange rate into a range so that our country do not suffer much due to the flexible. Okay, so our country, India, follows the managed floating exchange rate regime. A managed floating exchange rate regime, we can say it is a mixture of the fixed and flexible. That is, we let it float but in a range. Okay. So under which head of BOP differences between the credit and debit side of the BOP are classified? We are saying not like the discrepancy. Which of these shows the discrepancy? You have to tell this. Okay, so some are saying suspense and some are saying errors and omission, and this is the accounting question. It by mistake came here, so it can be like, see, when we are talking about discrepancy, then it is errors and omissions, but it can also be suspense account where the credits and the debits are not matching. So here we will leave this question. You can get this in the accountancy one. Okay, this is related to accountancy more rather than the economics. So we move to the next one. In India, RBI interferes to manage volatility in exchange rates to stop depreciation of rupee against dollars. So RBI should do what? Try to answer this one. Okay, so if RBI has to interfere because it is managed floating, if depreciation is continuously happening, then what should happen? That many of you are saying C, Anuradha has said sell dollars, and that is the right answer, that we have to sell dollars. And why do we have to sell dollars? Because see, our currency is depreciating. Okay, and when our currency is depreciating, so when our currency is depreciating, then we have to sell dollars, and when our currency is appreciating, we have to buy dollars. Okay, why we have to sell dollars when our currency, like in the case of appreciation, we are buying dollars so that the demand of dollars can increase, and when the demand of dollars will increase, the price of dollars will increase, the rate, the value of dollars will increase, and when the value of dollars will increase, the value of Indian rupees will decrease in terms of dollars. Okay, and similarly, like vice versa in the case of depreciation, that when our currency is depreciating too much, when we are losing the value of rupees, we are selling dollars. Okay, so that we reduce the value of dollars, and when we reduce the value of dollars, that means our currency is valuable in terms of dollars. Okay, so that the value of dollars has also decreased, so our currency has become stronger against dollar now. So in the case of depreciation, we are selling dollars. In the case of appreciation, we are buying dollars. Next is, as per the statutory framework with respect to the inflation targeting in India, which entity or entities will be responsible for setting of inflation target from time to time? So which entity, you have to tell that which entity is responsible, as well as tell me the name of the committee also that set the inflation target, that set the repo rate target, and that set the MSF and all. Okay, try to answer this one as well as the committee name also. Anupma, Suraksha, Tekken Games, and Agnik, Amit, they are giving the right answer. It is the Government of India in consultation with the Reserve Bank of India. If you must remember that which is the committee, then it is the Monetary Policy Committee that sets the inflation target. Okay, and in the Monetary Policy Committee, there are government members also, and there are RBI members also, and the RBI governor is the head of that committee. Okay. So the Monetary Policy Committee, constituted by the central government under section 445(b) of the revised RBI Act, determines the policy interest rate required to achieve the inflation target. And so the MPC, the Monetary Policy Committee, is the one that determines it, and 3 members are of government, 3 members of our RBI, and the RBI's governor is the Monetary Policy Committee's head. So next question is very easy question, this one. What is the correct order of the margin, we can say the interest rate corridor, the policy corridor? What is the correct order of the policy corridor? You have to tell this, and it is also again very easy. Try to tell the current rate also, okay, that what is the current rate of the reverse repo rate, what is the current rate of the repo rate and the MSF. So try to answer that one. So the right answer of this is very easy, that the MSF is greater than the repo rate is greater than the reverse repo rate. That is, MSF is the highest rate because it is taken in the emergency situation. Okay. Repo rate is the loan that is taken by the banks, and reverse repo rate is the deposit that the banks are doing with the RBI. Okay. So the loan, the banks, this is the emergency loan that is taken by the banks from the RBI. This is the loan that the banks take from the RBI, and this is the deposit that the banks are doing with the RBI. So of course, when you are depositing, less interest rate will be given. When you are taking loan, more you have to give. Okay. Then MSF, that is in emergency case, you will give much higher one. And I am getting, Anupma has said that RR is 4%. Very good, right? The repo rate is 4% right now. The reverse repo rate is 3.35% right now, and the SEBI has given a document recently that has said that this the reserve repo ratio will increase to 3.75, but that is only a document according to the SBI. Right now it is only 3.35%. Then there is also MSF. Okay, so MSF is 4.25%. So Nupma, Amit, Anshu and Himanshu, Nilesh, all of you have given the right answer. Anshu also. So now I hope you have understood the three terms: repo rate, the loan taken by the banks from the RBI; MSF, the emergency loan taken by when the liquidity is drying up; then the loan taken by the banks from the RBI; and reverse repo rate is the deposit or deposit that the banks is doing with the RBI. Okay. So which of the following is or are the components of the non-tax revenue receipts component of the Union Budget of India? So you have to tell this one. This one is also again very easy if you know the revenue receipts. Okay, so the right answer, see, dividend and profits from PSUs, the public sector undertakings, it is the interest payments received by the government, grants received by the government, loans received by the government. So what should be the right answer of this? And I am getting the answer E, and that is the right answer. So well done, you guys. People are doing really well. The revenue receipts are the receipts that does not, see, the revenue receipts neither reduces assets nor create liabilities. So it is not like we are selling and then we are getting the receipts. I am selling my house and then I am getting the money. It will not come under the revenue receipt. I am taking loans. That will also not come under the revenue receipts, and that's why the loans received by the government does not come under the revenue receipts. Okay, the dividend or profit, that is continuous payment, that is continuous income, that is coming under the revenue receipts. The interest payments received, the interest payments also regularly it is coming. The grants received, now the grants, it is not reducing the asset, it is not reducing the asset, it is not creating any liability, so it is also coming under the non-tax revenue. And you can see that what comes under the non-tax, what comes under the capital. In the capital, you are either reducing the assets, that is the recovery of loans, that is the loan has came back, so the asset has reduced. So you are either reducing the assets or you are increasing the liability. Okay, in the capital receipts, and this is the revenue receipts. Either you can get the tax revenue or non-tax revenue. Next is, which kind of policy involves raising taxes or cutting government spending so that it cuts upon the aggregate demand, thus economic growth, to reduce the inflationary pressure in the economy? This is again a easy question, and the first line itself tells that what kind of policy it is. Okay, try to answer this one. So yes, the right answer is contractionary fiscal policy. That is when you are, say in the contractionary fiscal policy, the government is reducing the spending and increasing the taxes. In this case, the government wants to reduce the inflation. The government wants to reduce the inflation, and when will inflation reduce? When the demand will reduce. Okay, so this is contractionary fiscal policy and this is expansionary fiscal policy, where the government spending is increasing, where the taxes are reducing. Next is, see, I have given the monetary policy here also, so that you can easily remember that what happens in the expansionary monetary policy, that the CRR, SLR, repo rate, reverse repo rate, MSF decreases, so that the banks have more money to loan, to give loan. And in the case of contractionary, when the inflation is too much and the RBI wants to decrease the inflation so that less money is in the hands of the people, so then the CRR, SLR, repo rate, reverse repo rate, MSF is increased so that less money is in the hands of the banks to give loans and less money goes to the people so that they do not demand much. Okay, and the inflation can be reduced. So this is the contractionary and fiscal policy, expansionary monetary policy. Next is, which deficit shows the total borrowing needs of the government to cover the deficit. So which deficit shows the total borrowing, you have to tell that. Again, a very easy question, I must say. So try to answer this question. Okay, so the answer is fiscal deficit, that is right. And why fiscal deficit? Because fiscal deficit is total borrowings. The fiscal deficit is equal to total borrowings, that is the total revenue, that is the total expenditure minus the total revenue receipts plus the capital receipts, that is other than borrowings. Okay, so this is the fiscal deficit. See, I am bringing such questions that cover up all of your topics. Okay, so the questions might be a little harder, the questions might be a little easier, but I am trying to clear the concepts behind it. Okay, so even if I am giving the easier questions, it is trying to show that how the concepts can be cleared. Okay, all of your concepts should be covered under the questions. That is the main motive behind bringing all the questions. Okay, so this is revenue deficit is revenue expenditure minus revenue receipts. Fiscal deficit is total expenditure minus total receipts excluding borrowing. So total receipts include the revenue receipts, okay, that the government is getting by not reducing the assets and not creating liabilities, and the capital receipts other than borrowings, Okay, so this kind of breakup of the term can also happen, and the government can the SEBI can give, that is the total expenditure minus the total revenue can be divided into RR plus CR minus the borrowings or other than borrowings. So you have to get ready for such kind of break also in the formula. So primary deficit means the fiscal deficit minus interest payments. Effective revenue deficit means that the difference between the revenue deficit and the grants, for that how much grants is being used for creation of capital. Okay, so that is effective revenue deficit. Next question is, which of the following expenditure creates assets or reduces liability of the government? This is an easy question, but this covers up your capital account. So try to answer this one. The PDF of the session you can get in the Telegram group, and so try to answer this one. So the answer of this will be, see, construction of roads, this is creating the assets, loans to states and foreign government. See, this is under the capital expenditure, we can say, where the expenditure creates the assets or reduces the liability. So creation of asset means that construction of road is happening, the land is being purchased, machinery, the investment is happening, and the reduction of liabilities being reduced, that you are repaying your loans. Okay, that is, asset is also being created when you are giving loans to the states and foreign government. So the starting questions were a little application based, but these later on questions were the starting of the concepts of the balance of payment of the foreign exchange. Okay, so you might find them easier, but it can be also that your preparation is going very good. Okay, so these kind of questions, see in the SEBI previous year question paper also the questions were pretty low level, but still we have to try for going for harder questions, and I will try to bring the previous year questions as well as some other hard questions in the next session. Okay, so thank you very much. If you have any query, you can mail us here or you can contact us through this number.